Great companies aren't built on average talent. In private equity backed, high growth businesses, the right operator changes everything. Onward Headhunting partners with founders, operators, and investors to build elite finance, strategy, and operations teams. From early hires to exit ready leadership, we deliver the talent that drives outcomes. If you are scaling or transacting, go onward. Visit onwardheadhunting.com or find us on LinkedIn to learn more.
This is Scott Becker with the Becker Business and the Becker Private Equity Podcast. Today's discussion is 14 thoughts on the healthcare private equity environment. So first, overall, a better deal market in 2025 and 2024 and 23. A good deal of investments, both really large deals and some bolt-on deals. A bit of a slowness in exits by mid-size and platform companies. Not a boom year 2025, but better than 24 and 23. Second, a ton of investments and growth in companies that sell into healthcare but that are not direct providers. Think revenue cycle, IT, business services, staffing, and more. Some of the big revenue cycle companies that are private equity funded include R1, RCM, Ensemble Health Partners, and Nimble Solutions. Third, continued growth in specialty practice management, particularly where there are solid margins and ancillary opportunities. Think orthopedics, GI, dermatology, cardiology, specialty dental, and behavioral health and urology. A lot of investment in companies that provide services to payers too. In the orthopedic area, think growth stories like Healthcare Outcomes Performance Company, Hopco in orthopedics, and many others. Fourth, there's a huge struggle in low margin specialties where PE adds debt, but margins are under real pressure. Think OB-GYN, primary care. Some of the boom is also off the road in the Medicare Advantage business. Some companies like Dewey Health and Care have really bucked these trends, a really successful private equity-backed multi-specialty practice. Fifth, PE, private equity, has about 800 to 900 hospitals collectively, a couple big blowups where low margin business meets high debt. The majority of PE-driven hospitals perform nicely. The big growth companies that blew up often included hospitals that were in real trouble to start with. So Steward Healthcare, sure, they made some serious mistakes, but about 10 or 12 of the 30 hospitals they bought were basically underwater when they bought them. LifePoint, owned by Apollo, is a really well-run firm. Ardent Health, which was PE-owned and is now public, was also a great PE-owned operator. Sixth, the OB3 cuts may be overstated. The rural behavior, $50 billion spend, is driving a lot of investors to chase those funds. So OB3 cuts are serious. A lot of the cuts are actually a reduction in increases than actually cuts, but we'll see how it goes in the next decade. Seventh, private equity is often scapegoated. However, reflects overall a small percentage of health systems and doctors. 7 to 8% of health systems, 78% of doctors, 7 to 8%. An insurance company, one insurance company employs more doctors than all of private equity combined. PE can relieve stress in an overwhelmed system. Eighth, in the venture capital area, a lot of investment in artificial intelligence firms that is booming. Incredible efforts to back the possible winners in AI solutions. Andreessen Horowitz, General Catalyst, Coastal Ventures, and others really taking that race to heart. A race to be the solution of choice. We're watching two of the big ambient listening companies, Abridge and Ambience Healthcare. It's like watching two great warriors compete in hand-to-hand combat to employ their ambient solutions. Ninth, long-term physician and other shortages may make physician practice management growth much harder. 10th, still a great deal of growth in outpatient facilities, ASCs, emergency departments, urgent care, and behavioral health. Also autism and other parts that are closely related to behavioral health. 11th, cash flow, deep product market fit, room for growth, acquisitions plus organic growth, great management, good margins, and measured reimbursement risk make something quite investable. 13, a lot of regulatory overhang in several states were starting to restrict PE investments in companies. 13, we see some funds with deep conviction keep trying to grow deep depth in an area. Some are trying to vertically combine technology and services businesses or software and services business. They're not necessarily SaaS firms, but they're trying to take a tech company and a service firm and try and vertically integrate to get tougher and tougher and tighter in the market. We've seen Bain and some other investors have deep conviction in different areas and really ride this to success. They got to have patience, they got to have money, and they got to have conviction. And they can often drive it to success. Last thought I'll have for you today is one great acquisition, one that really works, that really is an arbitrage or great winner, can make up for a lot of suboptimal bolt-on deals. Again, this is Scott Becker with the Becker Private Equity and Business Podcast. Thank you for listening to our podcast.